Scott, I'll start with you. You recently lowered your target for a year-end S&P, I think, from 5,100, but you're still some 300-plus points up from here. So What has to happen for you to be right?
Well, what I would say, what needs to happen is that the current path of earnings for the S&P 500 needs to continue to move down what we're suggesting, which is sort of a mid-single-digit ramp for Q1 and Q2 with a little bit higher rate of increase for Q3 and Q4. And then at the same time, we need to thread the needle here in terms of the ultimate economic impact of the Fed discussion just before, where as we get towards the end of this year, we need to look at a positive GDP and earnings outlook for 2023. And on that premise, I think we can then fall back on historical connectivity that shows that over longer time frames, the market can actually do pretty well when the Fed embarks on a rate hike path.
Yeah, well, let's talk a bit about that with Mandy as well. Well, give me your thoughts. You heard Steve. In terms of the Fed and what we're seeing is another 6 potential hikes this year. Are they on the wrong path, in your opinion? Is the chance for a mistake growing?
Yeah, so it's interesting, listening to the Fed, they're clearly more concerned about upside risk to inflation than downside risk to economic growth. And I think that is wrong. And it's not just me. I think the bond market also agrees that they're wrong in their focus, right? So I think there's this prevailing narrative that the Fed is way behind on inflation. But if you look at what is being priced into the bond market, long-run inflation expectations are actually still below average. So long-run inflation expectations remain remarkably well anchored despite very high inflation that we're seeing. And, 10-year at 2% does not indicate panic about inflation. And then if you focus on the growth, what the bond market is signaling right now is actually significantly rising risk of recession. So one of the things that we've been highlighting is if you look at money markets and what they're signaling, not about, Fed action this year, but say out 2 years in 2023 and beyond, the market's already starting to price in a full rate cut by the Fed. And that's almost unprecedented for the market to be, pricing rate cuts before this current cycle has even, gone underway. And that, again, it kind of speaks to the downside risks to economic growth. So I think for the Fed, I don't disagree that they need to be raising rates now, but, I don't think they need to be panicked about it. And I think there's a real risk that they become very aggressive and over-tighten this year or in the upcoming meetings and really kind of drive us into that, economic recession.
Yeah, that's a very interesting point. And Scott, just to tie it back to equities, if this is what the bond market is signaling, this rising risk of recession over the next couple of years, at what point do equities take their cue from that?
So there's a couple of ways to think about that, right? So, we've come to be accustomed to areas of growth within the equity markets proving to be defensive. And that's where the tech and the growth side of the ledger comes into the discussion. Here, the impetus has been that the markets look through economic valleys in the past on the premise that you do have eventually Fed accommodation coming in to resolve it. And given the weight within tech within the S&P, it becomes a pretty big toggle in terms of how you specifically factor in what typically would be thought of as economic downturn or recession impact on earnings. Your more traditionally economic sensitive side of the ledger, which is going to be industrials, consumer discretion, and so forth, potentially more risk on this. So what we have, I think, is going to be sort of a sector gamesmanship in terms of how forward-looking you think about the shorter-term economic consequences tied into higher commodity prices and Fed action, with the longer-term, run rate as we get to let's call it a more normalized Fed policy stance.